Hey there, savvy traders and curious investors. Welcome back to the channel where we dive deep into the fascinating and often explosive world of hard to borrow stocks and potential short squeezes. Today, we're putting a unique microcap on our radar, TGHL. We're going to break down why it's appearing on our hard to borrow screener, what that eye-popping cost to borrow means, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on TGHL. This is a microcap company, and interestingly, it doesn't have a specific sector listed, which can sometimes be the case for smaller, less tracked entities. When we look at its recent price action, it's been incredibly flat. TGHL saw a plus 0.0% change today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. And here's a critical point, today's volume stands at 0 shares, with the 30-day average volume also at 0 shares. This means its relative volume is 0x average. The estimated float for TGHL is 12.7 million shares. While the price and volume data suggests a stock that is currently dormant, its hard to borrow status is anything but. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and what is this cost to borrow we keep talking about? Show animation of short selling. When you want to short sell a stock, you're essentially borrowing shares, selling them, and hoping to buy them back later at a low price to return to the lender, profiting from the difference. But you can't borrow shares for free. There's a fee and interest rate, called the cost to borrow, or CTB. This fee is determined by the supply and demand for those borrowable shares. If a lot of people want to short a stock, and there aren't many shares available to lend out, the CTB fee skyrockets. It can even exceed 100% annually, which means you pay more than the stock's value in a year just to keep your short position open. It's a direct indicator of how scarce borrowable shares are and how much short sellers are willing to pay to maintain their bets against the company. Why the stock is hard to borrow right now. Now, let's talk about TGHL's specific CTB. Our screener flagged TGHL with an astonishing annualized cost to borrow fee of 773.1%. Highlight 773.1%. That is an incredibly high number, signaling extreme demand to short the stock relative to the supply of shares available to borrow. While its CTB momentum isn't available and the exact shares currently available to borrow are unknown, this 773.1% CTB alone is screaming scarcity. Our internal composite squeeze score for TGHL, which combines factors like CTB level, borrow supply, float size, and momentum, currently stands at 46.5 out of 100. This score indicates significant interest from our algorithms despite the current lack of trading activity. Squeeze mechanics explained. For those new to the game, let's quickly explain how a short squeeze works. When short sellers borrow shares, they have an obligation to return them. If the stock price starts to rise unexpectedly, these short sellers face potential losses. Short with rising price. If the price keeps climbing, their brokers might issue a margin call, forcing them to put up more capital or, crucially, to close their short positions. To close a short position, they have to buy back the stock in the open market. If many short sellers are forced to buy back shares at the same time, it creates a sudden surge in demand, pushing the price even higher. This upward pressure can trigger more margin calls, leading to a cascade of forced buy-in, thus a squeeze. A shrinking supply of borrowable shares, as indicated by TGHL's high CTB, can amplify this effect because fewer shares are available for new short positions or to cover existing ones. Dilution risk check. Before getting too excited about high CTB numbers, it's vital to assess dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can flood the market with supply, often depressing the stock price and making it much harder for a short squeeze to gain traction, even if the cost to borrow is high. For TGHL, we checked for recent dilutive SEC filings like -1, -3, or 424 BS in the last 90 days, and found none. We also checked for any recent reverse splits, and again found no activity in our look-back window. This is a positive sign for any potential squeeze thesis, as it means the company hasn't recently created new supply that could counteract upward price movement. Again, a quick but important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, with TGHL's 773.1% CTB and zero volume, what should we be looking for? While a high cost to borrow is a key indicator of short interest and scarcity, it does not guarantee a short squeeze. Sometimes, short sellers have very strong conviction that a company's prospects are poor, and they are willing to pay extremely high fees to maintain their short positions. However, the unique situation with TGHL having zero volume means that currently there is no active trading or price discovery happening. If this changes and significant volume comes into the stock, any subsequent price movement could be magnified by that incredibly high cost to borrow. Keep an eye out for any catalysts that might bring renewed interest or trading activity to TGHL. Without volume, the stock is dormant, but with that extreme CTB, it's a high-tension spring waiting for a trigger. TGHL presents a fascinating case study, a micro-cap stock with almost no recent trading activity, yet an astonishing cost to borrow, 773.1%. While its current status is dormant, this high CTB certainly puts it on the map for those looking to understand the mechanics of how to borrow stocks. Remember, doing your own comprehensive research is paramount. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into how to borrow stocks, and let us know in the comments what stocks you'd like us to analyze next.